guys, welcome back to the channel. On today's video, we're going to be talking about Canadian utilities. It's in one of my favorite segments. It's in the utility sector, and we're going to show you why it's a great thing to own utilities in your portfolio. I'm going to show you what Canadian Utilities is, what they've done in the past, where they're going in the future, and you can make the decision if you think you should have this particular utility company in your portfolio. Canadian Utilities trades on the TSX. It has a market cap of over $9 billion, a price to earnings ratio of 28, which in my opinion is getting a little bit high. That's pretty near the Apple price to earning range, to be honest with you guys. Now, the dividend yield is a pretty juicy 5.03% at a $35.01 per share price. They operate internationally and at home. They do natural gas transmission and distribution, as well as electricity transmission and distribution. I don't think this company needs too much of an introduction because as dividend investors, the people who are watching this video, you've all heard of Canadian Utilities, and there's a really good reason why, and that is the 49 consecutive years of annual dividend increases. Here's a chart from 1972 till present day 2021, and you can see the increase slowly all the way to where we are right now at $1.79 per share. So obviously those of you who bought in 1980, you are getting just an absolutely crazy yield, especially if you've been snowballing and compounding your dividends back into buying more shares of the company. Now, this 49 years of annual dividend increases is impressive on its own, but if they increase it next year, making it 50 years of annual dividend increases, they're going to qualify to be Canada's #1, first and only dividend king. A dividend king is a company that's raised their dividends for 50 consecutive years, and Canadian Utilities will become the first Canadian company to do it. Right on their tail, though, I'm going to have to mention Fortis. Fortis is right behind them. I believe they have 48 consecutive years, and yet again, that's another utility company. That tells you a lot about this type of regulated sector. It's good for long term. You are not going to get crazy price fluctuations, but it's a good hold here, guys. Speaking of price fluctuations, I've pulled up a 5-year chart of Canadian Utilities, and you can see they're bobbing in between $40 and $32 pretty much. This is something you need to keep in mind if you're going to purchase a stock. You are not going to get rapid growth acceleration in the utility sector. This is not a growth stock whatsoever. You need to buy this and think, hey, I'm just going to put this and let it compound. I'm going to get my 5% a year, maybe 2 to 5% appreciation on the stock price, and I'm going to be happy with that. This is for income investors, so keep it in mind if you're going to have this stock in your portfolio. Just have realistic expectations of where it's going to go. Now, on a previous screen, I showed you the 49 years of consecutive dividend increases, but, to get these years of dividend increases, you're going to need revenue increases, okay? So I just pulled that up here. This is their earnings growth from 1980 to present day 2021. Now, you'll see it's not up in a straight line, guys, because nothing really is. Businesses go up and down slightly, but if you look at the long-term trend, we're going north, and that's the correct direction. And whenever there's, if you look in recent history from 2008 to the current day, you'll see some bigger fluctuations here, and they're showing you why. Like, certain things are going to affect utility companies, like, well, basically any company. The 2008 financial crisis, flooding, wildfires. They give you reasons that their earnings are down, and I kind of appreciate that in a chart. Now, these slides that I'm pulling up, these are from the investor presentation, okay? So this is going to highlight positives for the company. This is reasons you should buy and you should feel good. But if we dig a little deeper, we can find a couple negatives with the company that I'm going to talk about. I'm not trying to discourage you, but it's just a more clear and honest way to approach looking at a stock. I just pulled up a debt chart for them that is not included in their investor presentation, okay? Now, if they did include the debt in the investor presentation, they would be showing how aggressively they are paying it off and their management's plan to decrease it over time. They didn't reference it. I'm not a big fan of that. So I pulled this up from another website, and you can see here their debt is $9 billion. And if you compare it to their equity, they only have $6.89 billion in equity. So that's a big difference. They have a 131% debt to equity ratio. Now, this is a little bit of a red flag, but we need to keep in consideration what kind of segment this company is in, and it's in a utility segment, okay? So that means a couple things. That means the upfront costs are going to be high, all right? So any utility company is going to have a ton of debt. You need to keep that in mind. Don't write them off just because of this, but keep it in mind, and we're going to take a look at their payout ratio next. So I pulled up their payout ratio from Yahoo Finance, and we can see here that it's currently at 138%. So a lot of you are thinking, well, hey, that's another red flag. Well, you're right, but we shouldn't look at that just on the face value. We need to dig into their quarterly reports, annual reports, and see what the trend is, okay? Because there was a situation this year that caused a lot of the companies to not make a lot of money. You all know what it is. I'm not going to get into it. So let's take a look at their financial reports, and we're going to see if this is a one-off or we're in a downward trend. So looking at their 2018 to present day, we're going to see a bit of the problem. We're going to see why the payout ratio is so high. If we look at 2018, we're going to see the total revenue of 4.3, the next year 3.9, and the next year 3.2. So that's a massive decline year over year over year. Now the trailing 12 months, we're starting to even out a little bit. We're at 3.2. We're almost at the year before. So we're evening out, but this is going in the absolutely worst direction possible. This is not what you want to see, guys. You want to see growth. You don't want to see decline. And here's just a bar graph showing you the exact same thing. We have too much of a decline here. Now, the thing with the utility companies are that they have one-offs, okay? And the Canadian utilities as a whole is changing directions, and this might impact earnings, okay? They're trying to be more environmentally friendly, and I'm just going to quickly go over what this transition entails. If we look at the ESG highlight section of their annual report, we're going to see a couple things. We're going to see that they did a 90% removal of the greenhouse gas emissions from their portfolio since 2019, okay? So during the year, a lot of people saw that the Canadian utilities sold off some assets. They didn't really disclose too much information at the time. Everyone was kind of wondering what's going on. Well, here it is. They sold off fossil fuel, a part of their portfolio, and they took that money and they're redeploying it into hydrogen assets, okay? So we're still going to generate electricity and everything, but we're just switching gears. We're changing the way we're going to do things here. And this is reducing their greenhouse gas emission, which is good for everybody, okay? Now, even the assets, the fossil fuel burning assets that they do own, they have created a 17% reduction in greenhouse gas emission. So they're trending in the right direction. And overall, they're boasting here that 23% of their global power generation portfolio is now renewable, including hydroelectric and solar. So this is pretty good. It's lower than a lot of other companies like Algonquin, but it's trending in the right direction. So good for them. And as long as they can be profitable with it, then I am 100% all for it. I just want to touch back onto their financial numbers there that we just looked at. So, with it going down, this is part of the reason. It's part of the transition into a more environmentally friendly process, okay? So a little bit less profits now because we have to pay up front for the transition, but in the long run, it's better for the planet, and it will eventually be better for shareholders, just not off the bat. Okay, so we looked at the numbers, we looked at the direction they're going in the future, we looked at the past numbers, and what we do know 100%, they will increase their dividend next year to become the first dividend king in Canada, okay? And this is good and bad, okay? It's good because it's going to get a lot of positive press. People who haven't heard of it before will start buying it. It's going to create a little bit of a buzz. It's a little bit of an accomplishment, a badge of honor for them, for the whole country, okay? On the negative, we already talked about the payout ratio being 138%. Even if the earnings recover a little bit, it's still going to be over 100% in my opinion. So we're going to be raising the dividend payout in an economic period where we're paying out over 100% of earnings. This is not great, but it's going to happen. So brace yourself for that. Where they go going forward, I couldn't tell you, but I would imagine the dividend increase is going to be like a penny per share. So current shareholders, that's what you can expect in my opinion. Let me know if you like this company, guys. There's mixed feelings on it. I don't personally own it right now. I'm not planning on purchasing it, but I'll keep it on my watch list. If it gets into the under $32 range, I might take a stab at it depending on the next quarterly earnings. It's a decent hold for income investors. Let me know. Yeah, right on, guys. Thanks for tuning in. Like and subscribe, and I'll see you in the next video. Thanks.